All right, folks, let's dig into another market update. And I wanted to talk a little bit about some of these stocks that have kind of gone under the radar during the last 4 or 5 months that have had some pretty incredible gains. And there's a common theme amongst all of them. And it's something that's kind of really interesting, something that we could definitely take advantage of in the coming months. We're also going to talk a little bit about the election that's coming up. I know a lot of people, and I remember last election, I had to talk people off of a cliff because they thought if Trump won or if Hillary won, the market would crash. So we're just going to go back, take a quick look at what the market looked like going into both of those elections. The one thing I would say, and the one thing to always remember, is that the market hates uncertainty. So, right now, because the market has no idea who's going to be president, there's underlying uncertainty in the market. And with all the money that the government and the Federal Reserve has pumped into the economy and the market, that's kind of the tailwind that has created this V shaped rally that I still cannot believe happened. Um, but it is what it is. We are where we are. But now we have another 3 months until the election, and let's take a look at some of the market action that kind of happens prior to election. So, November 2016, let's actually go to the candles. It looks a little bit better that way. So, November 2016, I think election night was the 9th, I believe, if I remember correctly. So 2016, let's zoom it in here. November. So this period of time here, this was where we are now. Okay. So, I mean, obviously there was a dip in the market, about a very, very slow and a very, very volatile 5%, let's call it, right? So going into the 2016 election, uncertainty kind of bringing the market down. Um, and, honestly, before election night, so I'm not going to get into what candles mean what, but I mean, that's a pretty bad look for a market going into the election. Once the election was finished and was realized, I mean, just it was a nonstop move up. So from election night to say March of the next year, the market was up 15%. So uh, the reason I bring this up again, just because I want people to get the historical references here, just because I think a lot of people get pretty scared. They read the headlines, they listen to all the commentators out there saying, "Hey, if he becomes president, the market's going to crash, and if that person becomes president, the market's going to crash." And um, you just kind of have to get a feel for it historically. So the other election, 2012. Now this is coming out of a pretty ugly, um, obviously, from 2009. So only 3 years out of 2009. So this is what this election looked like. This is Obama. Oh, that's 2011, 2012. Here we go. So February, March, April, May, August. There you go. So kind of a pretty similar thing, right? Going into the election. So I forget when the election was, but it was somewhere over here. And then off to the races, right? So that was the last two elections. Let's go back one more, which is going to be 08. Now 08 is a little bit of an outlier, right? Mainly because we were in the midst of the financial crisis. However, you're going to see a common theme here as well. So it's 08, November. Yep. So this is in the midst of a financial crisis, all the way down, and we had a bunch of volatility. So in the November 08, so as you could see here, market just took another big hit before the election, and then after the election, pop going into 2009. So that's three instances, and we can do this all day, but this is actually kind of why there's some seasonality to this. So every 4 years, you kind of get the same reaction going into November. Look at that. So that's down another 5% right around September. Bounces back up into October, and then right before election, just this little bit of action right there. So I just wanted to, again, the whole point of that is, I would expect some kind of volatility going into the election. That doesn't necessarily mean, we're going to go down 4, 5, 10%, whatever it may be. But I wouldn't expect us to continue to just rallying into the election. Seeing how I haven't expected us to continue rallying since May, maybe we do. So the S&P 500 is pretty much back to all-time highs. It's very likely going to take it out within the next week or two. The NASDAQ is continuing to hit new all-time highs after new all-time highs. Now remember, the NASDAQ is heavily weighted with these stocks, right? Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla. So as these stocks go, the index goes, all right? So I had taken this, I forget when I had taken this, maybe it was 2-3 weeks ago, but we're even above that now. So just keep that in mind. And it's one of the things that I always tell the clients, and it's like, look, it's really about 5 to 10 mega cap stocks that are carrying the indices. That's it. That's the only thing that's carrying this market right now. And you can see that by this chart here, one of my favorite charts. It just shows, so what breadth is that every tick up in the S&P or in the index, right? So every tick up in the index, how many stocks are participating in that tick up or tick down? In this case, we're at a historical low for the amount of stocks that are carrying the index higher. So basically you're at about, let's call it 35%. That means there's 65% of stocks that are not going up with the index when the index goes up. A historically low number. There's the only other time that this has happened, I think I had seen a chart dating back to like the 1980s. It had happened again in the 1980s, but this is something that hasn't happened in about 30 or 40 years. And so the reason why that's very important is that, and this is kind of the case against index investing, right? Oh, I'll just throw my money in the S&P 500 and call it a day. Well, you're going to get lapped by exponential percentages going forward if you think you could just play the market as a whole right now. There's two completely different markets in this market. There's growth that is going parabolic, which you could see here, right? So all these companies, all the technology growth, social media, software companies, just leading the market higher, just like in 2001, taking up 50% plus of the market cap of the index. It's just, we've never seen anything like this before. So there's two totally different markets at play, and you need to realize that if you're going to be allocating your portfolio. And one of the things we're going to get to in a little bit is how you may have been looking, the headlines always point to everybody's favorite stocks every single day. You turn on CNBC, it's always Apple, Amazon, Microsoft, and then maybe they'll throw in some new software companies that are coming out. But what they're not looking at are like the Tupperwares of the world. They're not looking at like the Big Lots of the world, the FedExes, the Dick's Sporting Goods. There's a bunch of stocks that are just doing incredibly well since the pandemic happened, and they're getting no airtime, but they keep going higher, and they're outpacing these stocks right here. And one of the best ways to really think about this is, and I thought this was actually told to me by a mutual fund manager, and he said, think of it like this: if all the mutual fund managers and institutional managers and hedge fund managers and all the managers out there that get to allocate portfolios, if they're all sitting in these stocks and their portfolios just literally cannot take any, you can't buy any more of these to put in the portfolio because you've hit your cap, you've hit your quota, whatever you want to say. Well, then at some point, at some point, once all the retail investors start taking those shares off of their hands, right? They have to reinvest that money, meaning that they sell it, finally sell for a profit. They have to take that money and reallocate it. Well, where are they going to reallocate it? They're going to pick out of all these undervalued stocks, all the companies that make money, companies that pay dividends, companies with good management, companies with good business models. They're going to end up putting the money into these. Now, does that mean they're going to 100% get out of Microsoft and Apple and Amazon? Absolutely not. There are mutual fund managers out there and hedge fund managers that will never not have these in their portfolio. But the current weighting of these in their portfolio, meaning the percentage of these versus other stocks, is extremely high, at the highest levels we've ever seen historically. So at some point, that's going to flip, and that's why we call it a mean reversion, right? So you're going to, and to talk a little bit more about mean reversion, just do the IWD minus IWF, right? So, other way around, IWF minus IWD. So what this is, again, and we've talked about this in the past, is what this is representing is for every dollar that is invested, 90 or 80% of it is going into growth stocks, and 10 or 20% of it is going into value. At some point, this is going to mean revert. And I think I've done this one for you guys before as well. So if we just compare it to X, right? So X, United States Steel, one of the most, as value comes. So you have Microsoft going like this, and you have value going like that. If value decides, okay, mean revert, and if Microsoft decides, okay, mean revert, this is huge potential. This is huge opportunity that you have in front of you. And this is just going to end up being a standard correction, right? So it's something that you really have to take into consideration right now, because this is at an extreme beyond extremes, and it's the reason why you can't just, at this point, just think you can throw your money at an index, because Microsoft, Apple, Amazon, Alphabet, Facebook, right? These are going to pull down the index. But while the index may be going down, let's see if I can, let's do, SPX, and then we're going to compare it to Microsoft. And then we're going to put everything into a line here. Okay. So the best way to show you this, and we had done this before, right? So Microsoft took off in the 90s into 2000. Value got no play, and the index kind of went sideways, right? Went up a little bit, but nowhere as much as Microsoft. And then in the coming years, that flipped on its head. But look what had happened to the index, right? So the index was carried down by Microsoft because Microsoft was such a high weighting in the index. And while it was bringing down the index, you have a company like US Steel going parabolic, which you want to get in down here. It doesn't feel good, right? It's one of those weird things where you wouldn't buy a car if the price kept going higher and higher, but most people want to buy a stock when it's going higher and higher. And the reason is it feels better, more green. Like the more times you see green, the more comfortable you are investing in a stock or whatever, or an index or a mutual fund or an ETF. But the reality is that you need to purchase it when you feel the most uncomfortable. And so if you can purchase it down here, right? Yes, it does take time for you to make money, but time is the great equalizer. So in this, again, it's this opportunity that's presenting itself to us. So right now, you can see that U.S. Steel has been just clobbered over the last 10 years. The index going up at a nice 45-degree angle as it should, and then growth going parabolic. So, okay, so then when this mean reverts, this is going to pull down the index, and this is going to keep it from collapsing. So I would be worried, like the thing about crashes is generally speaking, if it's not a pandemic that's hitting the country, a crash occurs when everything is overvalued. Okay. Well, this crash, even like if Microsoft crashes, it's going to pull down the index. But just because Microsoft and the index are going down doesn't mean that baskets worth of value stocks are going to go down. So that's just kind of a train of thought when it comes to when you're looking at the index, when you're looking at value stocks, when you're looking at growth stocks. So let's dig into some of these individual names and then talk about why they've kind of been working. And so let's pull it to the weekly here, and then let's look at Tupperware because I decided to bring that up. So back in, it wasn't in March. I wish it was in March, but I think it was in late April and early May. We decided to get into a couple of stocks, and it was Tupperware. So Tupperware since say April, late April, was up about 400-500%, and Big Lots. And Big Lots since let's call it Mayish, April, May, is up about 150 or so percent. And the reason I show you this is because you'd think a company, it's like, oh, Big Lots. Well, how is Big Lots going to survive? Well, Big Lots is like one of the best run companies in the whole entire country. It's not a flashy name, but when it comes to like discount retailers, it's absolutely one of the best. And discount retailers benefit hugely from any kind of recession or depression or any kind of economic turmoil because they're a discount store, meaning that people are going to go and look for value and they're not going to be purchasing overvalued stuff as much as they normally would, right? So they're going to buy all their needs from Big Lots. They're not going to go and spend an extra couple bucks at Stop and Shop for the same paper towels or the same toilet paper, right? So Big Lots has been a huge beneficiary of this. Another one, which most people now, FedEx is an interesting one because here's the thing: if nobody can go to a store to get something, what does that mean? It means it needs to be delivered. So United States Postal Service, UPS, FedEx, all beneficiaries of this kind of pandemic. But one of the other things too is that even though FedEx, has its up and down, has its ups and downs, it's still a very well-run company. It's a company that's absolutely needed, right? Like FedEx is never going to go away. It could get better. It could get consolidated. It could join up with another courier. I mean, but it's not like it's like Disney. It's like Apple. It's like Microsoft. It's never going to go away. You're going to see this company for the rest of your life. And so if that's going to be the case and you have an opportunity to purchase it from its high back in January 2018, purchase it at a 60-70% discount, 65% discount, that was the time to buy. And the crazy thing is that this is always the scariest, right? You never know how bad it's going to be. But again, when you're thinking of long term, when you're thinking 4, 5, 6 years, let's just say like you decide to purchase now and your time horizon is kind of like relatively short, right? 4, 5, 6 years. But like for me, I got 30 years, and some other people might have 20, 30 years themselves. And so again, if you think the company's valuable enough and you're getting it at a huge discount, right? There's no reason not to purchase it. And then on top of that, it pays a dividend. So you got yourself a dividend. It's not a great dividend, but it's a dividend. You got yourself a dividend. You got yourself a company that's crazy undervalued down here. Um, and yeah, so these are the type of companies that you should look at more, because you're never going to see these companies on CNBC. You just never will. They're not companies that are flashy enough to kind of get the spotlight. Worthington Industries. This is another steel company. This has done very, very well. Again, pays a dividend, up 120%. Silver, Silvercorp Metals. Again, not flashy. You'll never hear about it. Up 300%. This one. This was. Oh yeah, this is a. This is in my apparel basket. Um, I didn't even hear about the company until maybe 3 months ago, but this company as well, so up 250%. So again, I'm not cherry picking here. So what you're seeing is these are the companies, these are value based companies that are below their all time highs, that were at a huge discount when they were down back in March and April. Um, and they're companies that most of them that I've picked up all pay dividends, right? And the last one is Dick's. Dick's also, I actually don't know how they pay a dividend. I don't think I go to a Dick's like once a year. It's always for like tennis balls, but they've done really well. Up 200 and something percent. But the common theme of all of these stocks is that they're all value. So they're companies that pay dividends. They're companies that have been around for a while. They're not in growth mode anymore, so they don't fuel growth with debt. They're not these companies. They're not Coops, right? So Coupa Software, and we've gone through these before, but again, I just like, you got to see the difference in how and historically where these prices are. So you got companies like Coop, you got Lululemon, like just absolutely parabolic. And Lululemon doesn't even make sense to me that it's up this much. You're telling me that people in a pandemic with a recessionary economy are paying $100+ for yoga pants? I mean, get out of town. But it is what it is. Shop, right? Another company, again, going to be in our lives likely for the rest of our lives, but it at these prices completely overvalued. Team, SLP, Apple, even. I'm not, Apple, Amazon. Yeah, these companies are super valuable, but at what price is too high is really the question. One of the last things that I want to talk about here is something that's really important. So I had when you think of what's happening today, and I think we might have chatted about this in a prior video, but what's happening today is very similar to the 1990s. And what I mean by that is that in the 1990s there was a massive amount of interest in the stock market. And the reason is that not only were the regulations a lot more loose back then, I guess you could say. So the regulations were a lot more loose. So you can just literally peddle your stock on the radio or peddle your stock in whatever ads you want to. But people were getting very, very interested in all these, in the internet and the .com kind of bubble, right? So more and more interest. And it took about 10 years if you really think about it. Well, it took like 13. So you had 1987. So you had 1987 where, and that's this circle here, 1987, there's your big opportunity to get in the market. So it had a nice rally, goes down about 30-ish percent, whatever, 30 to 35%. And then from there, it's off to the races. Well, this was the generational buying opportunity. And then what had happened after that was more and more and more interest was gained in kind of the market. So people started realizing that you can make some money in the market. Now, you could see it's still a 45-degree angle going up through the 90s. And then in 95, it just started taking off. So one of the things I always say is like, look, like a 45-degree angle is great. Like you're making money. It's not a lot of speed, so you're not getting shaken out of your positions all the time. But also, it's just it feels better, right? You're not getting emotional when you get a down day of 2, 3, 4%. You're not getting like this greed that you get when a stock or something goes up 10, 15, 20%. You're not like, oh yeah, I'm gonna put more in and it's gonna keep going. And so this is like a perfect scenario to just kind of draw people in. It makes people feel comfortable that hey, the market's just chugging along, it's not going down. This is great. But then what happens is it takes on a whole nother angle. You can obviously see that 45-degree angle versus whatever the hell that is. It's a completely different angle. Well, what had got this to turn into that is exactly what's happening as we're already on a completely different angle right now. So one of the ways to really look at this is like this is your 1987, because I do think we have at least, I mean, we're like in the fifth or sixth inning of a bull market, of a secular bull market. So this was your 1987. And so right now, over the last 4 or 5 months, people have been getting super interested in the market. And the reason is you got all the young investors, all these kids, all these kids making money playing video games, all these kids home from school, these kids who just got a check, right? And anybody 18 plus just got a $1,200 check. They're getting interested in the market. I've heard so many stories of somebody taking $1,200, $2,000, turning it into 50. It's incredible, which is great. More power to them. That's what I had did when I was, I think, 22, 23. I think I had taken 10 ish and turned it into 50. You can get on a good run and keep going and going and going. But the point I'm trying to make here is that this interest that's generating, it started with Bitcoin. When Bitcoin in 2016, 2017 really took off, more and more kids were like, whoa, 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 I get this. I just have to get this Coinbase app, put a little money in, and then it just keeps going up. So that really started generating some interest. Now, with a 35% dip in the market, more and more interest got kind of piled on. So now you don't have any sports going on either. So now you got these kids. Now you've got kids who are interested, and then you got all the gamblers who are just throwing money left and right. If you look at like Dave Portnoy, the CEO of Barstool Sports, you're talking about a guy who built a media empire that took him about anywhere between 17 and 20 years now. Brilliant when it comes to like the media. But what he decided to do is, hey, I can't gamble on sports. I'm going to take millions of dollars that I have and day trade it. And so you've got to think of it in terms of sentiment. There's thousands of kids watching him trade. And somebody's going to be like, hey, I could do that. He's nothing special. And then that generates more and more interest. So what's happening is, and it's the reason why these stocks are kind of taking over the index, what's happening is that these kids are coming into the market, they're buying the companies that they know, they're leaving the companies that they don't know, like Tupperware and Big Lots and FedEx, for dead, even though they've rallied recently, but they're nowhere near their all-time highs like all these software companies and like these companies are. So you kind of have this generational opportunity in front of you. And again, and I harp on this because it's like, okay, fine, if you want to invest in the index, that's fine. But you're gonna be missing out at one of the fattest pitches that have ever been thrown your way. Like this isn't rocket science, right? Like I think a lot of people think in the market like oh, this is like completely rocket science. Who knows why a stock goes up or down on a daily basis? But you have to understand that no matter how much computers get involved, we're still humans. We still experience fear, we still experience greed, and greed is currently taking over right now like we've never seen before. And that's a good thing if you got in back in March and April. It's a bad thing if you're trying to get in now at all-time highs in some of these companies. So the opportunity in front of us is right here. it's okay. Well, if we know the mean reversion is going to happen, if we know these kids are going to have to invest in something else at one point, and if we know if mutual fund managers and hedge fund managers have too much money in some of the best stocks out there and they have to rotate at some point, where are they going to go? Well, they're going to go into companies like this, like Diana Shipping. That's an international shipping company. They're going to go into CLF, right? A non-energy minerals steel company. So we've seen a couple of steel. I think I showed you a couple of steel companies before that have kind of taken off. DBI, designer brands. Like this is going to start taking off. Gill, I think this one's already got going a little bit, but still, that has plenty of ways to go. You got a company like, this is for a trade only. This is not for an investment. But like even like GameStop, like GameStop still has billions in revenue. People wouldn't think that. Everybody think GameStop is dead, but they still have a pretty significant internet. They still have pretty significant e-commerce sales. Their website is pretty good when it comes to like purchasing games. So it's like they're not necessarily, yeah, their revenue's going down and they stopped making money like they used to, but this is still a pretty valuable company in that it has a sound business model that it's had for years. It's a buyout opportunity. I think this is only a trade. I don't think I would ever invest in GameStop, but there's people that are going to come in and think this is really valuable, and it's a company that you can definitely invest in. So, but even like some software companies, like we talked about how like most software is overvalued, but then you have a company like Slack. Like Slack's not overvalued at all. Like it IPO'd at about $42 a share. It hasn't been above 42 since the IPO, but it's built all this kind of base, all this foundation below it, and it's at a really really good point for an investment right now. Now Slack, if you don't know what that is, but that's all that is just project management. It's just kind of remote work centric type software. So the idea is that, okay, well, if we're going to be leaning towards remote work for the rest of our lives, then this is a huge beneficiary of that. Another one is payroll company, human resources payroll. So that's Workday. Now Workday isn't getting all the flash that all the other companies are, but Workday is a part of most corporations. So this is, again, it's a software company, but it's not completely overvalued. It's not a company that has gone parabolic. It's at a great spot right now. From a technical perspective, it's a trade and an investment at this point. So these are just some of like the ideas that are out there right now. So again, don't get too caught up in, um, don't get too caught up in thinking that one, you've missed the boat, two, that it's tough to find things to invest in. It's not necessarily hard to analyze, like the three kind of ways you analyze a company or a stock is technically, which means historical price, right? Which is what you're looking at now, a chart. Fundamental, which is like if you go to Yahoo, you could go to Yahoo Finance, click on financials for whatever ticker you want to use, and you could just see like look at like revenue for GameStop in 2018 was 9 billion. In 2019 it was 8 billion. In 2020 it was 6.4 billion. And so it's going down, right? That's obvious. But the point is it's still bringing in billions of revenue. And so like from a fundamental standpoint, it's going in the wrong direction. From a company value standpoint, it's still making billions of dollars in revenue. There's still people that go to GameStop. So like so you have technical, then you have fundamental, which is what you're looking at now. And then there's really just like kind of like macro business environment, right? So like if there was no pandemic, there wouldn't be such a rush for all the remote work and all the remote work software. There wouldn't be a rush for all the project management software or any of the like online design your website software like Wix. So but there's a rush for that right now. So that's kind of how like the macro environment has kind of changed the way you look at some of these companies. So it's, so if you know that, okay, well, the macro environment has completely changed. So what companies are going to be the beneficiary of the new macro environment? Then those are the companies you want to lean in on. And the one thing I would say is that you're probably like, well, then Kyle, I don't want to invest in I don't want to invest in value companies. Like, why should I invest in steel when I can invest in companies like Workday or like Slack, right? And which is a really good point. But one of the things you have to realize too is that if we do keep pumping money into this economy, which I really do think we're going to keep doing, I don't think the stimulus measures are done. If we get an infrastructure bill, you're going to see copper, steel, aluminum, cement. You're going to see like these boring ass material companies just take off. They're going to go up. They're going to dwarf the moves that Apple has made over the last 2 or 3 years. So you want to get ahead of that. And so, no, it probably doesn't feel good right now. Like I was showing you before, it doesn't feel good to get in Cleveland Cliffs. It doesn't feel all that great. Actually, I think, yeah, Freeport McMoran's taken off. That one's done really well. But it doesn't feel good to get in United States Steel. But this is the opportunity to do it. And this is at a point, and this is at a price where you might not have to ever look at it ever again until retirement. That's like straight up the opportunity that's out there right now. So, I mean, look, you're at like historical lows for United States Steel. And I'm not saying United States Steel is going to do this, right? 18x, 1800%. I'm not saying it's going to do that again. But what I'm saying is that the opportunity to do this is on the table. It's absolutely on the table. So that took 5 years. In 5 years, you just got it at one of its lowest points ever. So you kind of have to look at it like that. And it's like, okay, well, if you want to have Apple, just know that if you buy Apple at this price, you may not see this price again. Just like here, just like here. You might not see that price again for like 1, 2, 3 years. And you have to live with that because, yeah, it's probably going to go up beyond this high. But it's not like there may be another 10, 15, 20% in the stock. But that's about it for a while. You're not going to get, like, Apple isn't at an opportunistic price right now. But United States Steel is. So just kind of keep that in mind. And, like, also like Ford's another one. Ford's another, it's in that same ballpark of value companies. Um, I actually would not invest in Ford. I would not, like, I actually think Ford might tick that low, but neither here nor there. All right. So I just wanted to get you guys that market update, talk to you about a few things. Hope you enjoyed it. If you have anybody that wants to get on the email list, please let me know. If you guys want me to talk about different things, if more portfolio management, more like building a portfolio from scratch, how to invest, when to invest, all that kind of stuff, feel free to ask. I'd be more than happy to help you guys out. So everybody have a great weekend, and I will talk to you next time.